As it is teacher Shoppi Eria from Una Education Services. I welcome you all to our lesson today. In this regard, we are continuing with understanding the double interest system. Those who haven't watched my previous videos about the single interest system and the double interest system, it is better you go and watch them so that we can move on the same pace. So I have the fourth worked out example on understanding the double interest system or the dual recording. And here it goes. Janice started business with a cash balance UGX 50,000 and a bank balance of UGX 200,000. Then incurred the following transactions. On 2nd January 2026, bought goods for cash UGX 80,000. Then on 3rd January 2026, paid rent by cash UGX 40,000. And then on 4th January 2026, sold goods for cash UGX 10,000. Then on 5th January 2026, paid electricity by cash UGX 45,000. Then on 5th January 2026, sold goods for cash UGX 60,000. Then our question goes, required, post the above transactions in a ledger. So we are going to be posting this. We are going to be using the double interest system to post these transactions. So this is how we post it. Remember, you are dealing with the double interest system, and I've said the double interest system, a transaction is recorded twice, and that twice being recorded twice, one is recorded on the credit side, and it is the account that is losing out money or giving out the money, and then one is recorded on the other side, which is the debt side, and the debt side is the receiver side. So the account that is receiving money is going to be dated, and then the account that is losing out money or giving out the money is going to be credited. We said crediting means recording a transaction on the right hand side of the account, and then dating means recording a transaction on the left hand side of the account. So this is a solution for our worked out example for questioning worked out example 4. So we begin with solution worked out example 4. So this is the left hand side and this is the right hand side. So the right hand side is for the credit side, which is the losing side or the giver side, and then the debt side is the left hand side, which is the receiving side. So from our question, we said we begin with the first transaction. So the first transaction was Janice started business with cash balance of UGX 50,000. So we recorded that. So if Janice started business with a cash balance or balance brought down of 50,000, meaning this amount of money had remained in the previous period. This is January, meaning it remained in December 2020. December 2025. So she had to carry it on in the next year, meaning this was capital. The money we used to start a business from this question, started business with cash balance, meaning UGX 50,000 was in cash and then the 200 was in the bank. So 50,000 was capital. So we apply to the double interest system. We apply one by one. So 50,000 was cash, but it was from the capital account. So meaning Janice was receiving this cash, but from the capital account. So we begin posting it in this way. So this is how we post the transaction. So we begin with the capital account because the money we use to start a business is called capital. So we begin with the capital account. Now, if the capital account, if Janice received money, if Janice received cash of UGX 50,000, meaning he received it from the capital account, and then we said that when capital is increasing, when capital increases, we credit it. When capital increases, we credit it. So capital here increased by 50,000. So meaning we're going to record capital. We're going to credit capital because if capital increases, we credit it. And this capital was losing money. Remember, it was also losing money to the cash account because capital has to give money to the cash account for the business startup. So capital was losing out money and capital was also increasing, and when it increases we credit it. So meaning we're going to record this January 1st cash ledger 2 in the credit side, because capital was increasing, and when capital increases we credit it, and even it was also losing out money to the cash account for the business startup. So this 50,000 is going to be recorded twice. We're going to save January 1st cash and then put it here and record it in the amount section on the credit side. Then we record that same amount of money in the cash account, because cash was receiving money from the capital account. So we are done crediting it here, and then we come and also date here again. So you come and record it here. January 1st, it was receiving money from the capital account, and the capital account is ledger 1. So we put 50,000 here, meaning we are done recording that. That's why I told you that in double entry we recorded transaction. Every transaction is recorded twice. So the 50,000 has been recorded, has been credited by recording it on the capital account, and then also dated by recording it in the cash account, because it is in this regard it is cash that was receiving the money, meaning, and cash is also an asset, and said if an asset increases it is dated. So cash was increasing, and if an asset, which is cash, increases we date it also. So here we date capital. Okay, then we are done with that. Let's go to our next next transaction. Then we said I had a cash balance of 50,000 and then a bank balance of 200,000. Meaning, if Janice had a bank balance of 200,000, meaning this was also capital, but it was in the bank. So meaning capital is going to transfer that money to the bank account. So this is capital, it is 200,000, and then it is going to be transferred to the bank account. Now in this regard, it is capital that is giving to the bank. So we are going to credit capital, because capital is increased by 200,000 and it was getting money from the bank. So we credit capital. We said if capital increases we credit it. So capital was increasing and at the same time losing out money to the bank account for business startup. So we record this transaction as January 1st. It was receiving from the bank, and our bank is ledger 3, and then record it in the amount section. Then we come and also record this, because the accounts here were bank and capital. So we put it in the bank, we record it on the credit side in the capital account, and then we also record this amount because the bank was receiving money. So bank is an asset, and if bank is an asset, we said if an asset is increasing we date. So we come and date it here. So bank was increasing or receiving money from the capital account, which is 200,000. So we date the bank and credit the capital account. So that is how we record it here. So this is just January 1st. It was receiving money from the capital account, and our capital account is ledger 1, and you record the same amount of money. So this is the double entry system. We record the transaction twice. We're done with that. Let's go on second. On second they said on 2nd January 2026, bought goods for cash UGX 80,000. Bought goods for cash UGX 80,000. So if you buy goods for cash UGX 80,000, meaning that is a purchase. That is a purchase, and it is an expense. So we say that if an expense increases, we date it. So if an expense increases, we date it from our previous table. If an expense increases, we date it, and when an expense increases, we date it, and when it reduces, we credit it. So in this regard, it was increasing. So if we purchased or bought goods for cash UGX 80,000, meaning we are going to date the purchase account because it was gaining the commodity bought. So we just record January 2nd, it was receiving money from the, meaning it is receiving this money from the cash account, and the cash account is ledger 2 here. You can just count these ledgers. It is ledger 2, and then record this amount here. So it is a purchase, it is an expense, and if an expense increases, and disregard an expense increased by 80 40,000. So we date the purchase, and then at the same amount, in the same regard, we are going to credit the cash because the cash was losing money to the purchase account. So you come and record also January 2nd, it is getting money from the purchase account. So it is losing money to the purchase account, and so we record it here also. So this is how we record it twice. So you're seeing how we record it twice. Now we are done with the second. Transaction. Let's go on third. We said on 3rd January 2026, paid rent by cash 40,000. Now we first identify that accounts here. So we have the rent account and the cash account. So if you pay rent by cash, meaning you're going to give in the cash and for payment of rent, meaning rent is going to gain the money and cash is going to lose out the money. So in this regard, if we're going to date the rent account and credit the cash account, because we said if a revenue increases, we credit it. So we are going to date the rent account because it is an expense. So if an expense increases, we date it. Then cash, which is an asset, if an asset reduces, meaning you're going to pay for cash and it's going to reduce, meaning cash is reducing, and if an asset reduces, we credit it. So we are going to date the rent account and credit the cash account. It is here. So we are going to rent. So we are going to date the rent because when the purchase increases, we date it. So rent is here. We are going to date the rent, which was on 3rd. It was receiving money from the cash account, and the cash account is ledger 2. So we record the 40,000 here. So our accounts were cash. So we record the same transaction here because cash was losing money to the rent account. So you come and record it here also. So we are going to credit the rent because cash was giving money to the rent. So we are recording the same amount of money on the credit side on the cash account because cash was losing. So January 3rd, rent is ledger 5. We record the same amount of money, 40,000. Meaning we are done recording. We are done recording 3rd January. Let's go on 4th January here. Then 4th January, we said 4th January, sold goods for cash UGX 10,000. Sold goods for cash UGX 10,000. Now the accounts here are two. We have the sales account and the cash account. Now if you sell goods for cash, meaning you've sold goods and you're losing out the goods and receiving cash. So in this regard, cash is going to increase. Cash, which is an asset, increases, and if an asset which is cash increases, we are going to date the cash and then credit the sales because sales is revenue, and when revenue is increasing, it is also credited. So we are going to credit the sales and date the cash because cash was gaining money from what it sold. So you come and see it from here. The sales. We have the sales here because when you're selling, meaning you're losing the goods. So we are going to come and say on 4th, which was 4th, it is cash and we sold goods for 10,000. So it is cash. It is losing out money from. It is losing out money to the cash account, and then the cash is ledger 2, which is 10,000. Then we come and credit the cash account in the same regard. So on 4th, because we sold goods, we have to receive cash. So here we're receiving cash. So on January 4th, same, we come and record this amount, meaning cash is receiving money from the sales account, and the sales account is ledger 6, which is 10,000. That is the dual recording, meaning we are done recording on 5th. Let's come back and record on 5th. On 5th January, paid electricity by cash UGX 45,000. We said that if an expense increases, we are going to date it. Meaning, in this regard, electricity is an expense, and if an expense increases, we are going to date it. So an expense, which is electricity, increased by 45,000, and cash which is an asset, decreased by 45,000, meaning we are going to date the cash. No, we are going to date the electricity and credit the cash, because cash, which is an asset, was decreasing. So we credit it, and then we are going to date electricity, which is an expense, since it was increasing. So we are going to record this same amount of money on the electricity, on the date side, on the electricity account, and then record this same amount of money on the cash account, because an asset, cash being an asset, it was reducing or decreasing, so we have to credit it here. This is what I'm talking about here. So come and record it here. We have electricity. We said electricity is an expense, and when an expense increases, we date it here. So electricity account is going to be dated. So you come and say 5th January, it is going to be getting money from the electricity, from the cash account, and the cash account is ledger 2, and record it the same amount here. So we come and also record, we go and credit the cash, because it is losing out money to the electricity account. So you come and record it here also. Electricity on January 5th, it is losing out money to the electricity account. Remember, we are crediting it, so it is losing out money to the electricity account, and electricity is ledger 7, so we record it here also. So that is how our question is, and that is how our question is. There is this last one. Then on 50 again, sold goods for cash 60,000. Sold goods for cash 60,000. So we say if you sell goods for cash, meaning you're going to lose the goods and receive the cash. So if cash increases, we said cash is an asset, and if an asset increases, we date the asset. So in this regard, cash, which is an asset, is increasing. So we are going to date the cash and credit the sales. So cash is going to be dated because it is increasing, and then we are going to credit the sales because you're giving in the goods. So cash is gaining and the sales account is losing out the goods. So you record it in the sales account. Then you come and just click on the cash sales. It is receiving the money. We are receiving money from the sales account, which is 6,000, and then you go to the sales account also and credit it because it is losing out the goods to the cash account here. Come on, record it here on 50 cash ledger to 60,000. That is how we record this transaction, and that is how we record those transactions. This is our question, and that is how we record it in the double entry system. This is how we record it in there. Hold on, let me show you. Let me just play it for you again. This is how we record it in the double entry system. This is our solution for example 2. So go and research and make more analysis for this. So this is how it looks like. This is our ledgers extracted from our example. We have many examples coming on, so just tune in and watch more videos coming on about the understanding the double entry system or dual recording. It is teacher Shoppi Eria from Una Education Services. Thank you for listening. Let's meet in the next videos. Thank you.